Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter like we normally do, see what people are sharing on social media. I'll interject my financial opinions as we go, and it's generally related to three different topics: wealth building, financial topics, and or commodities. So let's dive in there. Let's see what people are sharing. You can follow me at finding_finance. And you can join our community at finding-value.com. We still have the LEAP coupon code going on, 50% off the first month to try it out, then normal pricing, or a larger discount on the yearly membership if you're interested. We do have a question and answer session Sunday at 5 p.m. Mountain Time. Scrolling down, we've got Art Berman. He says, drain America first. Shale gas production from the Haynesville has begun to decline. Appalachian and Permian output growth is slowing. So what this is saying is drain America first. Shale gas production from the Haynesville has begun to decline. Yeah, so this is one thing I'm going to say, though. We're not exactly at high natural gas prices right now. In fact, we're at very low prices. So I wouldn't attribute the decline in production to geological forces yet. If we were going to attribute that to well declines, the production of wells and the we'll call it the decline of productivity of those wells and the drilling. I'm not going to make that claim when natural gas is below $2 a million cubic foot. I would much rather see that if we're going to be in a decline with natural gas around $8-10 MMBTU or a million cubic foot. That is where I would start to wonder, hey, maybe we're hitting geological constraints here. But right now, with natural gas price where it is, I think we're going to naturally see it decline to some degree, just because of the pricing. Shanghai silver versus COMEX silver. So over in Shanghai, we've got 27.28, and then we've got here 24.89. What's with the difference? Well, all I'm going to say is that metal is going to move to the east, and it's going to be drained from the west because you can get an arbitrage doing that. You can buy it here and then sell it over there for $3 more. Why not do that? Or $2.38, $2.38. Well, they're going to take advantage of that arbitrage. QE says, this wouldn't surprise me. People are locked into their 3% mortgages. This will keep inventories low. Says the mortgage lock-in effect is here to stay and home prices won't fall for years to come, Capital Economics has said. Well, I hate to tell you, but if we lower the mortgage rate, that doesn't necessarily mean that inventories are going to grow. That means that there's going to be more people who can afford the homes if interest rates go down. And inventory doesn't increase if one person buys a home and another person sells one and buys another. It keeps it relatively flat. All that really does is have high turnover rates. And turnover rates make everybody in the real estate industry wealthier because they get a piece of that sales. So sales are going to decline. And it's not that it's going to keep inventories low. It just means that people aren't going to churn the inventory. Inventories will be low no matter what. You have to build new homes to increase inventory. And that's what we haven't really done yet. So it's just musical chairs and homes with a certain amount of people given the amount of homes out there that are for sale. So if you've got 40, 50, 60, 100 homes for sale, whatever, let's say it's 100 homes for sale, but you've got 300 buyers for those 100 homes. The price goes up to an unaffordable level to price out a lot of those people, approximately a few hundred, depending on what you want to price out and what the sellers are willing to ask and get for those homes. And whatever's left over is your inventory. So just because you have 300 buyers and you have 100 homes doesn't mean that all 100 homes are sold. Maybe only 25 to 50 of them are sold. And the other ones are junk that people don't want to pay that price for. It's hard to say. It depends on the clearing prices. It's not as easy as if rates went down, people would sell their house. It's like, well, where are they going to live? If the majority of people only have one home, they're going to sell one and buy another or sell and rent. I mean, it just doesn't go poof, here's a bunch more homes. VBL's Go says they're all in on it. I want to read this one here. He says, Bretton Woods 3 is a process, not an event. It's something I say a lot lately. Here's where that came from. It originally started in August 2022 after Zoltan Rita, CPIC. It hatched, but was too crazy to talk about until recently. Now it can be. Still speculation, but they're all in on it. China, the USA, Japan, everyone. They're all buying gold for some form of monetization to facilitate international trade in a post-unipolar world. And none of them is letting you know it because they want you to sell it to them. And that includes Bitcoin. I've never been so convinced of such an outrageous sounding conspiracy theory than the one I'm creating right now. And it became even clearer December 3rd when China called the Bank of International Settlements to ask to keep the price of gold down, reportedly. But I still waited. It's insane, unscientific, and unprovable. Now it's practically staring us in the face. Ask yourself, is all that gold being delivered out of the COMEX leaving the US? It can't be. Still unprovable, but evident enough to warrant taking precautions. Happy to be wrong, not taking chances of being right. So Zoltan's latest Bretton Woods 3 is destined to happen. It's already happening. So I don't know what's going on, but I'm a gold and precious metals guy. I hold this stuff because that's what I think it underpins our entire financial system. It's what keeps people somewhat honest, but I don't think these people are being honest. I think they're cheating the system. I think they're printing way too much fiat currency, and I think eventually there's going to be a gigantic revaluation in precious metals. And I include every single precious metal: palladium, platinum, silver, gold. It doesn't matter. They're all going to get revalued way higher. Every commodity, even. Shaban Guard says global onshore crude inventories are now at fresh lows as refineries take advantage of strong product demand and crack spreads to process record volumes of crude. Financial markets are pushing the price higher as it catches up to the reality that physical markets will remain strong. Here's the global crude onshore inventories, and this is how low they are. Fresh all-time lows and going across. And we're almost outside of we'll call it the 5-year average cloud with the standard deviation. So this is going to get real interesting because generally we get drawdowns from about March onward. We can get some pretty heavy drawdowns. This one, the drawdowns were from June to October. We'll see where we're at, but we've got pretty strong drawdowns even before the big drawdowns occur. So you can see that we've got some builds here historically, and the builds haven't really made a dent in this move lower. So this is going to get real interesting here, guys. And with crack spreads as high as they're at, crack spread is the refiners make that money between oil and gasoline, the refining process. If crack spreads are high like they are, they're going to try to convert as much oil into finished product, gasoline, diesel, whatever it is. So this is a real interesting setup because it's going to put the pressure on oil itself. So they're going to want to refine as much as they can to make as much as they can with margins being this large. And it's going to draw in oil and put a shortage in inventories of oil products. And we'll see what the gasoline products do on the back end. Going on down to Peter Schiff. He says, Oil's above $82, up 15% so far in 2024, and the first quarter hasn't even ended. Oil is on track to end the year above $100 a barrel, especially if the Fed cuts interest rates. What's the odds that oil is up 40% or more in 2024 and the inflation rate is anywhere near the Fed's 2% target? I don't know where the made up inflation target will end because it's all made up, so I don't really care about that. But I mean, if we go above $100 a barrel, if we go real slow up to $100, I'm just going to say that we are going to make a buttload of money the way that at least I'm positioned. I mean, a buttload because I'm in a lot of the high cost producers for oil and energy service companies. And when looking at all those ETFs, they look pretty dang good. And I've got some charts later on in this showing you what they look like towards the end of this. The EIA Drilling Productivity Report, Part 2. So according to the DPR, U.S. shale oil production would have peaked in December of 2023. And with the current number of well completions, the low number of frac crews in 24, the EIA model predicts no further shale oil production growth. So basically, we're going flat. If we go flat, we've got the refiners pulling oil, and we don't increase the volumes from Saudi Arabia, well, oil is just going to go to whatever price they want it to go to. So this is getting interesting. That's all I'm going to say. It's going to get tight here, and we could be at the world's pumping capacity at some point with no spare capacity. Here's a fun fact. We're in a rising rate environment. The best part is that many investors think that rates are going down, which is hilarious. Yeah, if you look at it from a long-term perspective, we've broken the 40-year downtrend. This is more zoomed in to the previous 2023, 2024 year. And we're sitting there moving on up. Are we going to go lower? I don't know. I don't know if we're just going to go on up. Sometimes the 10-year yield gets linked up with the price of oil. And if oil is going up, I could easily see a higher 10-year yield going on up. And I think that's probably what he's alluding to. New data came out. Housing starts hold steady at 1.52 million, and housing permits are also holding steady, roughly at about 1.52 million. So there we are. Let me see if I can get this in here real quick, guys. So there's the housing starts. You can see that we are right there holding steady pretty much. The housing starts, if you look at this chart here, it's very similar to the price of oil too. It's like housing starts and oil are all financialized and correlated. This is the driver of inflation if these new homes get new loans put against them. And this is housing permits. And you can see that we've been just drifting slightly higher each month in permits for this. So it's holding together as of right now for housing starts and permits, which generally does not indicate a recession. Recessions, if this drops down like this, if you see how these big drops in housing starts, they almost always end in recession. In 2000, we didn't have a huge drop. We had a little bit, but we did have a recession, and then they just started creating all these loans. But we're holding steady at this current time. That's what I'll say. Grady says, institutions still having the old 60-40 stocks bonds waiting is misconduct. Problem is, banks, brokers, investment firms are not interested in clients' returns, but only in fees. Plus, they have very little commodity knowledge. One cannot rely on old institutions and correlations. And what he's showing here, and this is, I talked about this before. Someone mentioned on Twitter that my opinion is we could have oil go up quite a bit due to physical tightness in the oil markets. And we could have gold move up simultaneously with oil and potentially even interest rates. This is exactly what I mean by the divergence between gold and bond prices. Now, TLT is the bond price for the 20-year bond. This is bond prices. And you can see how they were correlated before 2020. They were very well correlated. In 2020, 2021, they started to break that relationship, and we clearly broke in 2022, where gold is moving up and bond prices on the 20-year are moving downward. What does that mean? It means that gold is moving up with interest rates. And generally, if I were to put my guess on why this is occurring, is that people are trusting the system and the bond market less and less. So the spot to be, in my opinion, when this starts to occur, and it already has occurred, is to be in precious metals to preserve wealth. This isn't about making money. It's about preserving what you have and using it as a savings account, so to speak. So physical metals, I don't look at them as like, oh, I'm going to get rich off physical metals. I look at it as like, I got to diversify out of the system to some degree, because if the currency has a problem, how do you transact out of your investments into something else? You have to come across that currency. But if that currency has a big problem, I don't want to cross across that currency. I'd rather just hold my assets and have liquidity from my physical assets. That's my opinion and my take on it. Coming down, Grady again, he says, agreed. It sure is very compelling chart with far-stretching implications. He's talking about the copper versus NASDAQ ratio. It's a 45-year chart. We came on down all the way and bottomed in 2000. This entire environment was basically a resource-rich environment with declining interest rates, we'll call it declining costs. We hit bottom in 2000. We've come on up and put in basically a short-term peak in 2008 and 11. Then we came all the way back down. And I think what's causing this chart in its entirety, here's my guess. I think oil's driving this chart. Oil and demographics. So with shale oil coming on, we drove it back down to this double bottom. I think we had a physical tightness in the oil market that occurred in the mid-2000s, and we also had a credit expansion. But it was still in a declining interest rate environment. What we have here is an increasing interest rate environment, much like the 1970s. I also think that we're going to come into physical tightness with oil globally. When we get into that physical tightness, I don't know if they're going to find something else to replace at the margin, the oil that's being lost. Maybe we do, maybe we don't. I don't know. But if we don't, I think this is going to go up dramatically, like a 25x like he has, of copper outperforming the NASDAQ. Now, that's the NASDAQ going down and copper going up at the same time. He says the ratio was back at the same level as during the dot-com bubble back in 2000. When the ratio moves up, copper outperforms the NASDAQ. And we're showing the same positive divergence last time it moved, much like the early 2000s and where we are today. I think that we're at the beginning of a very big commodity bull market. Now, could we have a recession before it actually gets kicked off? Some people speculate that we're going to get a recession first, and the Federal Reserve is going to print a bunch of money and do a lot of stimulus, and they're going to get scared about a crashing technology, like basically a tech crash. They're going to overstimulate, and it's going to drive commodities because they're in the shortages. With so much shortages, the credit that was created at a faster pace than what the commodities can catch up to is going to create a massive inflationary wave where commodities just go ballistic. So I think that's possible. I don't know if that's going to be the path or the way that we're going to move forward. It's difficult to say. We've got fiscal spending that is just going nonstop, and fiscal spending can hide nominal declines because it's going to be inflationary. And some people say it's stagflation. That's exactly what it is stagflation. The Bank of Japan hikes interest rates for the first time in 17 years. Is this the start of a new era? I don't know. This is going to be interesting. Now, the way that the dollar declines is you get the other currencies to start hiking their rates, and in America, we start lowering our rates. That will increase the currency of the rate hikes value in relationship to ours if we lower interest rates. And this does look like a double bottom. Here's that, and then the double bottom. Here's CRB inflation, reflation, stagflation. In any case, commodities. He says that we are here, in his opinion. I'm not so sure of that. I think that this is wave one, and then we have a pullback, and we have a big move up. The reason I think that is you can draw this line going across here, and this is a three hump consolidation. Generally, you move up in three waves: wave one, wave three, and then wave five. The pullbacks are 2 and 4. So I think this is wave one, and I think that we are in a consolidation, which is almost ready to break out. And I think we're going to go into wave three. So if it were my guess, and I don't know everything, guys, this here I think is this here, and we could get a move on up where we actually pull on back for a sharp kind of move like this. That is possible if we get like a tech crash or something going on. I don't know what that path will look like necessarily. To me, it looks like a lot of the stocks and ETFs look pretty strong to move higher. So maybe we don't get that large pullback like we would in a tech crash. Maybe the fiscal spending is going to overwhelm any sort of problem with the tech crash, and maybe even tech continues higher and they just print money like mad and throw it in the stock market. We'll see, but um, I think that we're earlier than what this guy thinks, because this is at the beginning of wave five. I don't. I think we are. I think this is 200%, but I think the 200% is this move here. Another thing that you can also tell where we're at is using the ratios. The commodity stock ratio is still like super, super, super cheap. So I don't think, I think he's got this circle wrong. I think we're over here, somewhere in this range over here. Bitcoin, that's an interesting chart. He's got a shoulder with a neckline and a potential break, or actually it did break, to the downside. So we could see a much lower price on Bitcoin. People could get scared here. I'm ready for the move. I've got crude oil and ETFs. Let's do a quick look here. I've got XOP, which is the Spider S&P oil and gas exploration production. I think we've got a shoulder, a head, and a shoulder that's developed with a big move. This is the bottoming pattern, which means that we're buying the bottom over here of the right shoulder. We break this, now we're in a new uptrend. So the bottoming pattern's done and we go into some gigantic uptrend. So this is signaling that we have a long way to go with a lot higher move. This is PSCE, Invesco S&P Small Cap Energy ETF. It's the same setup. Shoulder, head, shoulder, with the neckline going across, and we've broken out. Big move to the upside. If you do this on a logarithmic basis, it pushes it way past everything we have on this chart here in terms of price targets. This is crude oil. We can also see that we've got the 1, 2, 3 consolidation, and then we've got the consolidation there. We've broken to the upside, and we've hit support, which is the upper trend line, and now we're coming back up. So we have a long way to go. I think that basically where we're at, if you were to look backwards, you have a 1, 2, 3 hump consolidation. We've broken out. That's the breakout of this line going across. I don't have the line on here, but if you draw a line through here, you have a breakout and a retest. I think we're right here in the retest. And that's why I think that we're earlier than what that guy had said before. We're at the retest. Now, are we going to go up and do one last retest, like slingshot move lower, which occurred right here? I don't know. I'm not betting on that. I'm just betting that it's going to go higher over a long time frame. But that's what I see. And this is the data to support my opinions on it. The three-wave consolidation, the breakout of that consolidation, the retest is where we're at. And we're at the beginning of wave 3, which is a big move. And then we have a blow-off wave 5 top at the end. There's crude oil zoomed in. I know it was up today as well, but you can see the stair-stepping pattern that we've got, which looks absolutely fantastic, and we're breaking above the top trend line. Looks really good for crude oil. Here's Patrick Karam, and I love crude oil, guys. I really do. It's like the master commodity and the most inflation sensitive asset commodity too. SPX priced in crude oil. So probably one of the most important capital flow charts out there. It's probably one of the most massive head and shoulders topping patterns morphing into existence. And that's why we've got these inverted head and shoulder patterns on energy. The head and shoulder pattern is for energy to outperform the S&P 500. And that's the correlation that we've got between all of these charts. They're all the same thing. when copper is down here and it's so cheap, this is just signaling that stocks are overvalued and copper's undervalued. It's commodity. It's the same thing that we've got going on over here. A head and shoulders bottoming pattern in dollars for crude oil ETFs or the companies, the equities ETFs. And then we've got these big patterns here, which is the SPX versus oil, which is a topping structure and another huge topping structure. He calls it a mega big topping structure where oil is about to outperform the S&P 500. I completely agree with his assessment here. 1,000 billion trillion %, as my 6-year-old would say. So basically, this is the outperformance of stocks in a certain market condition. This here is a peak in 99, 2000. We came down, put another peak in. You can put a line through here. It's a shoulder, head, shoulder. And then we declined all the way to this bottom. The ratio was 8-to-1. We climbed again under a disinflationary environment in a recovery phase of real estate. This was the expansion phase of real estate. This is the recovery phase. And then we are also in an expansion phase of real estate, which compresses this lower, which is another key indicator that we're in an expansion phase of real estate, that it's going to be inflationary, and that the market agrees with that assessment. So we went on up again from 8 all the way to 100. There's an exhaustion age, all the way to 200. So the S&P outperformed oil from 200 and an 8 starting point. A huge outperformance from where we were today to the bottom of 2020. I purchased up here, I purchased right here too, a whole bunch of oil equities. And I'm writing this thing down all the way. This is when we get to this right shoulder and we start to compress lower, which I think is occurring or about to occur almost right now. This is where you're going to get that big commodity boom shift, where money's going to shift from we'll call it financial assets into commodities and the commodity equities. This is where gold, silver, uranium, oil, and copper thrive when this comes back down. We are coming there soon. Now, could we get a wick at the top here where we get a slowdown in the market? It's very possible. I don't want people to think that this is just going to be a straight line. We could get a wick. We have a little wick there that occurred in 2000, 2001. We could get another wick where we get a technology sell-off. People get scared. If we get that, that is going to be an incredible buying opportunity. I will be alerting all of my members that are part of my community, that I am a part of, that I am going in big at that point, which I'm already in big. But if we get that buying opportunity, if the market allows us to get fear to creep into the market and give us that one last great buying opportunity, I am going to capitalize on this that I've never done before. I'm gonna capitalize like no other. Then we're gonna get the big move downward. We get that big move downward like we did here. I mean, that is like early retirement for everyone, baby. That is what we're looking for. So we are still early in this move. You haven't missed anything. It's going to require patience, and choosing the best companies is going to give you the kick in the pants move. When this does occur, it's gonna light up the portfolio with zeros on the end of it, hopefully. So great chart there by Patrick Karam there. And then that's where I'm going to end. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. You can see all the individual companies and how I'm playing this. I am a gigantic energy bull, and I'm a gigantic precious metals bull. And that includes coal, ammonium. It includes oil and natural gas and uranium. I like all of them. That also includes all the precious metals stuff and the metals miners. I like copper. I like base metals, aluminum, steel. I've got companies, all for that stuff. And that also includes precious metals, the physical metals, and even the mining companies. I think they're all going to do incredible things. If this thing does rhyme like the 1970s, we could see precious metals miners do some crazy stuff, like crazy, crazy stuff. So they're still incredibly cheap. We do have gold and silver looking pretty good, like they're trying to break out. So this is a good time to be looking at the mining companies and maybe even the royalty companies too, depending on what you're looking at. So that's what I've got for today, guys. We'll catch you later. This is Finding Value.